In today's video, we're taking a look at one of the most shocking and sudden crashes in modern financial history, Black Monday, the stock market crash of October 19, 1987. On this day, the world watched in disbelief as stock markets around the globe plummeted. But what caused this catastrophic event, and how did it impact the global economy? Let's find out. The state of the economy before Black Monday, the late 1980s, was a time of relative economic stability. The United States had been experiencing a period of growth, following a major recession in the early part of the decade. Stock markets were on the rise, with the Dow Jones Industrial Average hitting new highs. In fact, 1987 had started with great optimism, and many investors felt confident. But beneath the surface, there were growing concerns, rising interest rates, geopolitical tensions, and signs of market overvaluation that hinted at potential trouble ahead. The trigger: what happened on Black Monday? On October 19, 1987, the stock market crash hit with stunning speed. It started with a sharp drop in the early morning hours, and by the end of the day, the Dow Jones Industrial Average had fallen by 508 points, or about 22%. The largest one-day percentage loss in history. This massive decline was so sudden that it caught both investors and financial experts completely off guard. What caused this crash? There wasn't one single factor. Instead, several things converged to spark the panic. Causes of the crash: overvaluation and program trading. First, there was overvaluation in the stock market. Stock prices had been rising rapidly in the years leading up to the crash, creating an environment where investors were paying more than the companies were actually worth. This created a situation where prices were artificially high, and a correction was overdue. But the real catalyst for the crash was program trading, the use of computers to execute large stock trades based on preset rules. When stock prices began to drop, these automated trading systems sold off shares in massive quantities, creating a snowball effect and accelerating the panic. It was a perfect storm: human fear combined with automated trading, sending the market into a free fall. The global impact: while Black Monday originated in the United States, its impact was felt worldwide. Stock markets across the globe followed the U.S. market's lead, with major exchanges in London, Tokyo, and Frankfurt also experiencing steep declines. In some countries, stock markets lost as much as 40% of their value in a single day. This global panic signaled that financial markets were becoming increasingly interconnected, and a problem in one market could quickly spread to others. The aftermath and economic consequences: the immediate aftermath of Black Monday was a period of fear and uncertainty. Investors faced massive losses, and the U.S. economy seemed poised for another recession. But surprisingly, the economy didn't immediately collapse. In fact, the stock market began to recover relatively quickly. Within 2 years, the Dow Jones had regained its lost value. However, the crash did have lasting consequences, particularly in how markets were regulated and how investors viewed risk. The response: Federal Reserve and government action. One of the reasons the economy didn't plunge into a deeper crisis was the quick response from the Federal Reserve. Under the leadership of Alan Greenspan, the Fed acted decisively, lowering interest rates and ensuring liquidity in the banking system. This helped stabilize the financial markets and restore some confidence. In addition, the U.S. government began to scrutinize program trading and took steps to regulate it more effectively, including imposing limits on the use of automatic trading strategies. Long-term effects: reforms and market changes. Black Monday led to significant changes in financial markets and how they operated. One of the most important outcomes was the introduction of circuit breakers, which are mechanisms that temporarily halt trading when the market drops too quickly. These were put in place to prevent another panic like the one that occurred in 1987. Additionally, there was a greater focus on regulating automated trading systems and improving market transparency. The event also made investors more cautious, leading to a more conservative approach to stock market speculation in the years that followed. Lessons learned from Black Monday. Black Monday served as a stark reminder of the dangers of speculation, overvaluation, and the lack of regulation in financial markets. The crash showed just how fragile the stock market could be, especially when automated trading and herd mentality combine. It also highlighted the importance of market stability and risk management, both for individual investors and for the broader economy. Black Monday may have been a shocking event, but it was also a turning point in financial history. It reshaped the way we understand risk and market behavior, and it led to reforms that continue to protect the market today. What do you think? How did Black Monday influence your view of stock markets and investing? Let us know in the comments below. If you found this video interesting, don't forget to like, subscribe, and hit the bell icon for more insights into financial history. Thanks for watching, and we'll see you in the next video.